G'day, Professor Joseph Drew. A lot of people get very confused when they're reading accounting financial statements, particularly when they're public accounting financial statements. It's a whole different kettle of fish. Of course, to understand it thoroughly, you need to do a 2 years Masters of Accounting, which is what I did before my PhD. But in this video, I'll give you a 5 minute, quick tour of the basics so that you can get a better handle on things. Okay, we're going to look at the income statement, and we're going to also have to look in the balance sheet also in a different video because that's also very important. So the income statement is where we record income and expenses, and you can get an overall operating result for a council. You'll find 2025 written in the current financial year, 1st of July from previous year to 30th of June 2025. And next up, for comparative purposes, you always find the previous financial year. Those figures there should be exactly the same if you downloaded the 2024 financial statements. Sometimes they're not. They should be marked as restatements when they are changed materially, but sometimes, sadly, they're not. Please take note that financial statements for local government are typically in thousands of dollars, otherwise the numbers just get too big. So there's two main things that we're looking at here. We're looking at the income, and then we're looking at the expenses, and you need to go all the way down here. The state government's recently changed the accounting code to confuse everyone. And of course, if your expenses are more than your income, you've got a deficit for the year, and that's your overall operating result that you can see here. But it's not even that simple. For public accounting, you really have to look at those figures right down the very bottom, and everyone wants to stop before then because it suits them better to stop before then. But you really need to look right down the bottom, because we need to exclude capital grants and contributions, and I'll explain why in a minute. You also need to know that these figures here, when you see them in brackets, it means they're negative. It's a deficit. Okay? So the income is made up of your rates and your annual charges, and for each item you'll see these letters here. It's what's called the notes. There's about 100 pages that follow these statements, and you can flick to the appropriate note, B21, and you can see what makes up that particular thing, rates and annual charges. Use charges and fees, other grants for operating purposes, which can be spent on anything, so we don't have to exclude that to get a sensible idea of what's happening, but grants for capital purposes, which can't be spent on anything. And that's why, going back down here, let me change the color so we're all clear about where we're looking. We need to be really focusing on this bottom number. We need to exclude the capital grants. Now, to explain capital grants, as I said, you've been given money by a federal government or state government or developer to build a certain thing. And by law, you must build that certain thing. You don't get to use it for other things, okay? So it's like me giving you 50 bucks to go down to the bottle shop to get me a carton of beer, okay? If you actually did that, you're not $50 better off. You can't spend that $50 on ciggies or food or whatever you're after. You've got to actually spend it on the beer. And if you do that, you're not $50 better off. So how could you include that in your income? More so, you'll find what most councils find, which is that when you get to the bottle shop, the carton of beer is not 50 bucks, it's more like 90 bucks, and you're actually out of pocket on the deal. So you cannot get a sensible understanding of where the council is without excluding these capital grants, because those capital grants can't be just used for anything. It's as simple as that. Now, on the expenses side, it's roughly in thirds. Typically, about a third is employee costs and on costs and entitlements and all those things. A third is usually typically materials and contracts. It's not quite exact. And a third is usually depreciation. I think most people can understand most of those categories, except for the depreciation, which is confusing a lot of people, and confusing a lot of people in our state governments across the country. It ought not to. There are Australian accounting standards backed up by law, and Australia has signed up to a thing called the IFRS standards, which is what just about every OECD country uses. So what is depreciation? It's the measure of the consumption of an asset, long-lived assets, over time. Okay, so let me give you an example. Say you buy a truck for 40 grand. A year down the track, it's not worth 40 grand anymore. 5 years down the track, it certainly isn't, is it? Every year it goes down in value because of market value changes, but also because you're using it and it's got wear and tear, the engine's done more work, etc. So of course it's worth less. Now, if you don't account for that, measure how much the value has decreased by, you're not getting an accurate sense of the financial position of a council at all, have you? Now, councils in any government are very asset heavy and they're very heavy on non-productive assets. So this depreciation figure is absolutely essential. You can't ignore it. The state government's trying to sideline it as if it doesn't matter. It does matter. Whether you like it or not, those trucks and roads and everything else, their value is going down because they're being consumed. And if you don't measure that and capture that as an expense, which it is, you're not going to have any chance of having a sensible idea of what's actually happening with the council. Okay, so they're the main elements, but please, please, please look all the way down to the bottom of the income statement because it's that figure excluding capital grants, which is the one that actually means something for us. Look, I'm aware that I've probably upset all the accountants out there because it's far more complicated than what I went through in a 5-minute video. As I say, knock yourself out, go and do a 2-year accounting degree. But this gives you the general gist of things, and now you understand why we've got to have things like depreciation, because we don't expense the whole lot at the get-go when we first build the thing or buy the thing. What we're going to do is measure the cost as it's consumed over the time. It should also give you an idea why we've got to exclude those capital grants, because we can't just spend the money on whatever we like. So of course it's not real income in the sense of untied revenue and untied income. Anyway, I hope that was illuminating. Thank you very much for your time. Goodbye.